Good morning, Matthew with Profitero here, and I thought on Smart Investing Saturdays, we'll discuss different investment strategies, different types of stocks, bonds, mutual funds, that kind of thing. And so I've got a little bit that I want to discuss today about ETFs. What are they and how do they work? And although I'm not a financial advisor, I'm not an investment expert, this isn't financial advice. This is just, simple, discussion about what that looks like. And it's really for my own education. So I'm excited to learn from you as well. If you have any suggestions, make sure to put them in the comments there. And make sure to like and subscribe these videos if you're interested in hearing more about these different playlists that I'm building out and different videos I'll be doing. I'm interested in your opinion. If you want to provide me some feedback about videos that you'd like me to dig into and discuss, I'll be happy to put a video together for you. So exchange traded funds, they're described typically by the acronym ETF. It's a type of investment fund that holds a collection of assets like stocks or bonds or commodities and trades on an exchange like a stock. And they track the performance of a specific index. So like, for example, the S&P 500, a sector like technology or energy, and an asset class like bonds, stocks, mutual funds, or whatever. And so the shares of the ETFs can be bought and sold on a stock exchange throughout the trading day, allowing for flexibility similar to individual stocks. Okay, and the types of ETFs, essentially there's 5 different ETF types. There's index ETFs that track a specific index like the S&P 500. There's sector or industry ETFs that focus on a particular sector like healthcare, technology, energy. There's bond ETFs that invest in government, corporate, or municipal bonds. Commodity ETFs track and price the commodities like gold or oil. International ETFs invest in foreign stocks or bonds. The advantage to us as investors with ETFs is that it gives you more diversification. You gain exposure to a wide variety of assets within a single fund, reducing your overall risk in that investment. And they're cost efficient. Generally, you have lower fees than mutual funds and often a good choice for cost-conscious investors. So a lot of times you can invest into an ETF and then just let it go to sleep. And you don't have to, track it daily. You don't have to try to monitor it very often. It's a widely diversified fund. So you're going to be safer than if you were to invest heavily in one particular stock. Flexibility on ETFs is trade throughout the day as like stocks, so you can buy and sell whenever the markets are open. And transparency, ETFs disclose their holdings daily, so you can always know what's in your fund, and that's an interesting aspect. So like the S&P 500 changes, and those companies that are in one week may not be in the next week, and that does definitely impact how the S&P 500 performs. ETFs versus mutual funds. The next step is discussing how they're different. For example, trading, ETFs trade like stocks, while mutual funds only trade at the end of the day. Fees, ETFs usually have lower fees compared to mutual funds, and ETFs can be bought by the share, whereas mutual funds sometimes require a minimum investment. And so you might have to put down $5,000, $10,000 in order to get into that mutual fund. Where to buy or how to buy ETFs. You purchase those through a brokerage account or an online trading platform by searching for ETFs as a ticker symbol, and then decide on the number of shares you want to buy and place an order just as you would with any stock. Some popular examples of ETFs are SPY. It tracks the S&P 500. The QQQ or Invesco QQQ, that tracks the NASDAQ 100, focusing mainly on tech companies. And VTI, Vanguard Total Stock Market ETF, covers the entire US stock market. And you can see there's going to be winners or leaders, and there's going to be losers or other stocks that are going to drag that index down. So when you have ETFs like this, you diversify your overall risk because you're not heavily weighted towards one investment over another. Some of the risks, though, to consider on ETFs is the market risk. Since they track indexes, if the market or the sector declines as a whole, the ETF value also falls. So, for example, if there was a let's say restaurants or entertainment. If there was a pandemic, you would see a lot of that pull back, where there wouldn't be a lot of travel, there wouldn't be a lot of dining out, there wouldn't be a lot of hotels that were being booked, that kind of thing. And so you'd have the market risk of, if there was another pandemic, those ETFs that were focused on those types of markets or sectors drop. Now there is liquidity, and since niche ETFs may have lower trading volumes, making them harder to buy or sell. And then finally, is an ETF right for you? ETFs really could be a good choice for investors, both new and experienced investors that prefer an affordable, diversified, and flexible investment option. And so that's just basically a very, very brief overview of what ETFs are. If you have experience with ETFs, put it in the comments. Let's hear some of your favorite ETFs. What are you investing in? What are you considering? Or would you like me to dig into another topic? Make sure to like and subscribe, and I look forward to the next time. Thanks.